As Jeanette mentioned, we're going to talk about profit pricing and options. And I do want to be very clear, regardless of whether you trade options, this is critical information to have. So you can apply a lot of what we'll cover on the session today for equities trading, ETF trading, all of those great things. So before I dive in, I'll just cover a quick risk disclosure with you. Trading securities and options involves risk. Prior to buying or selling an option, an investor must receive a copy of characteristics and risks of standardized options, and of course need a broker to trade securities and options, and must meet suitability requirements. We are going to be going over some various results on our session today. Just know that anything I share in terms of results, of course, will be past results and are not necessarily indicative of future performance. All right, so with that out of the way, let's kick it off. So by the end of our session, you're going to discover one simple method that has the power to transform your trading. This critical information is hidden in every options trading platform. You may not know it's there, but you're going to by the end of the session today. So I'm going to show you where to find it, how to use it to stack the odds in your favor on every trade that you place. So whether you're just starting out or you're a seasoned veteran, this is must-have information for today's markets. So you're going to discover the one simple number hidden in every options trading platform, where to find it, how to use it to stack the odds in your favor on every trade that you place, how to make more confident options trades and generate consistent results, and how to uncover short-term high probability options trades that target 50 to 100% returns in under 2 weeks. So we're going to be looking at some short duration option strategy. And I think you're going to be really impressed with some of the results that we can potentially achieve with these. I'll just give you a brief background on myself before we get any further. Again, I'm Jeff Tompkins. I've been trading the markets for over 2 decades. I've essentially traded everything under the sun, equities, ETFs, futures, Forex, even crypto. I started back in the late 90s as a retail trader. So I was just trading my own account, went through all the trials and tribulations, blew up accounts, jumped from system to system, tried every indicator out there, and probably a similar journey to many of you, right? We all kind of go through that process, but it took me well over a decade to reach a level of consistency and confidence to where I could, if I wanted to, quit my job and trade for a living. Ultimately, I launched a hedge fund where I serve as the hedge fund manager at Altos Capital. And my goal here is to break down the gap between retail and institutional. As I mentioned, I previously traded on the retail side, and back in the early 2000s, I completed a trader internship at the trade desk at Morgan Stanley. And the first thing I noticed was there are all these tools and methodologies that the institutional side has available to it that is hidden from the retail side. And that was really frustrating for me. And of course, now that I trade on the institutional side and manage money professionally, my goal is to level that playing field, to narrow that gap so that it's a more fair game. Okay, so that's why I'm here. That's what I enjoy doing. So as you can see, I'm a keynote speaker and educator. This is me at one of the recent International Traders Expos, but I really enjoy teaching others and leveling that playing field. So let's start to dive in. Let's first focus on some problems that we face in our trading and investing. Whether you realize it or not, a lot of retail traders are entering trades with the odds stacked against them from the start. Now, I'm not necessarily a conspiracy theorist, but a lot of people think or realize that the market's kind of stacked against you, right? There are some things that maybe we don't have available to us or that we can't see. So a lot of people will say, well, the market's rigged. Well, I don't know that I'd go that far, but it is unfair. Okay, I'll say that. And there are certain aspects that, that do stack the odds against you without you realizing it. So we're going to cover those. And we're going to do it with a very simple statistic. So we're going to look at how far the market is expected to move. So by the end of the session today, you're going to know with confidence how far the market is likely to move by any point in the future. Okay, we're going to look at which direction is the market going to move. Okay, so that won't be a question mark anymore. Where do I take profits and how do I define my risk? How do I avoid getting stopped out of trades that would have been profitable? This is a big frustration that we all face. I've had this happen many, many times, right? Where you get into a trade, a directional trade, you're obviously forecasting future price movement, and you might actually be right, but you're not right at the right time, right? You don't time it correctly. So the market moves against you initially, and then you get stopped out, and ultimately the trade goes on to work, or the direction goes in your original forecasted anticipation. And so that's what we have to address. Okay, and I'm going to give you a really powerful trick to eliminate that that problem. Okay, which strategy is the most appropriate? So this is also a challenge that we face because in the options world, we have all these strategies. So, you know, two traders can have the same outlook. They can both be bullish. And you have a number of options in terms of strategy selection, right? You could buy a call. You could do a vertical call debit spread. You could do a call butterfly. You could do a calendar spread. But the important thing is some of those strategies, while they might have the same outlook, are not necessarily appropriate. And so we're going to break that down as well. Which strike price and expiration cycle should I choose? This is also a big question mark. We have all these strike prices to select from, all these expiration cycles. Back when I first started trading options in the late 90s, we only had monthly expirations, right? So we had contracts that expired on the third Friday of every month. That's it. And that was a big limitation. But as time went on, right, then we had weekly options that expire every Friday. Now we have 0 DTE options. This has completely changed the game. It's given us information that we previously didn't have available to us, and we're going to look at that. But again, by the end of our session, you're not going to be guessing which strike price to select. You're not going to be guessing which expiration cycle to select. So what I'll give you today to make it easier, you're going to discover one simple method that will stack the odds in your favor on every trade that you place. I'm going to give you hedge fund level tactics used by veteran traders to help you make more confident and consistent trade execution. We're going to look at selecting the right option strategy for any market condition. Again, a big mistake I see retail traders make is just not selecting the appropriate strategy. Choosing the optimal expiration cycle for your trades, right? This is huge. That can drastically impact how a trade plays out in your ultimate P&L or profit and loss. Okay, applying these strategies to any options on stocks or ETFs. So everything I covered today is really universally applicable. You can take this information and apply it to any optionable security, and how to take what you discovered today up to the next level. So stick with me to the end because I'm going to show you how I can really, really accelerate all of this. All right, so let's start to dive in. I'm going to show you exactly how this works in real market conditions in a way that you've never seen before. So you're going to learn exactly how to spot opportunity before the move occurs. I'm a big advocate of forward-looking information, right? I do not like lagging indicators, and unfortunately, that's what's predominantly available to the retail trading crowd. How to structure trades with a built-in edge. Okay, so everything that we're going to look at has built-in edge, and that's critical, right? We have to have a positive expectancy in our trading strategy to make money over the long run. Manage risk like a seasoned pro. Trading is just a risk business. It's like the insurance business, right? It's all centered around risk. So we have to control it. We have to know what our risk is. All right. Now I'm going to give you a position sizing hack, and it's called sizing for zero. This is something that I have noticed is highly underutilized on the retail side. It's predominantly used, or nearly always used on the institutional side. I size for zero on all of my options trades, and I'm going to explain what that means. So I'm going to give you a couple scenarios. Let's say we're willing to risk $1,000 on a trade, okay? And let's say we're bullish on ABC stock. So we have, again, a number of option strategies we can select from, but let's keep it simple. We're going to buy a call option because we think the ABC stock's going to go up. And let's say that call option costs $1, right? So each contract controls 100 shares. We could invest in this trade $100, right, on one contract. But if we're willing to risk $1,000, right, we could trade 10 contracts, right? That would make sense. But we could also trade 20. We could trade 50. We could trade 100. Why is that? Because you can use a stop loss, right? So that would be scenario A. Let's say we could buy 20 contracts. Well, if we bought 20 contracts, we'd have to use a stop at 50 cents to adhere to our risk threshold of $1,000, right? Or scenario B, we could buy 10 contracts and not use a stop loss. So in both scenarios, your risk is identical, right? It's $1,000 in both scenarios. The big difference is with scenario A, you can get stopped out. And I've got a kind of real world anecdote I'll share with you real quick. We did this in our Altos Live trade room a couple months back. We went in, we were bullish on the SPY, okay? We thought the SPY was gonna go up intraday. So we went out and bought a 0 DTE call, 0 days to expiration, very short duration day trade, okay? And we got into the trade and it moved against us at first a little bit, right? And then it started to move against us more. And very quickly, those contracts that we bought, which I think we bought for around 30 cents, were trading down to a penny. So had we used the stop loss, we would have gotten stopped out of that trade. But we didn't. We sized for 0 and traded the appropriate number of option contracts as if those contracts went to 0 without exceeding our risk tolerance. And ultimately, we were right on the direction. We just weren't right on the timing. So the SPY did end up going up closer to the cash close, and we closed the trade out for a profit. So this alone can immediately increase and improve your probability of success. Okay, so we always want to size for 0 in our options trades because that way we can't be stopped out, and it gives us the trade more room to run and work out. Okay, so that's the position sizing hack. Now let's start to dive into volatility. Now there are different types of volatility. You have really 3 types. Historical volatility, as the name implies, what happened in the past. Current volatility, what's happening right now. That would be like the VIX, the spot VIX, which is also forward-looking, right? It's implied, so that's where implied volatility comes in. What does the market expect the volatility to be over the course of the next 30 days, right? So we're concerned with all of those, but we're mainly concerned with implied volatility, right? That's a forward-looking predictive indicator. And it's the option market's forecast of future price movement. So it's going to tell us with a high degree of accuracy how much an underlying asset's share price is expected to change by a future date. And it's readily available in every retail broker platform. Okay, so I'm going to show you where to find this. But let's first break down how to predict the move, okay? Now, implied volatility is, as I mentioned, a measure of how much the market expects the price of an asset to fluctuate in the future, but it's also a key factor in determining the price of an option contract. So some of you might be familiar with the Black-Scholes formula. It's a very complex formula that determines how options are priced, right? Well, we can really boil it down and simplify it into implied volatility. And there's a direct correlation. So the higher the implied volatility, the more expensive the option premium. And conversely, the lower the implied volatility, the less expensive. And you option traders out there have probably heard, right? You want to sell high implied volatility, buy low implied volatility. We're going to dig a little bit deeper into that. All right, but traders use IV, and I'll refer to implied volatility as IV, to gauge whether options are cheap or expensive and to determine the possible outcome of an options trade. So it's influenced by supply and demand, okay, and the market's expectation of the amount of stock will move. So here's the key. It tends to increase ahead of a major announcement or event and then decrease after the event has passed. And the example I like to use is a company's quarterly earnings announcement. So I call that a known unknown event, right? As you're leading up to it, you know it's coming up, but you don't know what the results are going to be. And so that creates fear and uncertainty. And for that reason, implied volatility increases because we don't know what the reaction is going to be to that information. But once that information is known, right, after the quarterly earnings gets announced, the implied volatility drops off a cliff. It goes way down. We call that vol crush. Okay, that's important to know. Now, there's different ways to measure it. When we look at implied volatility percentile or IV rank, we measure it on a scale from 0 to 100. And this is my interpretation of levels of implied volatility. I consider 0 to 20 to be extremely low, 20 to 40, relatively low, 40 to 50 more in the medium range, 50 to 80 moderately high, and anything above 80 extremely high. Okay, so we want to know what the IV rank or implied volatility percentile is when we're making trading decisions. That's very important. It'll help us decide whether to buy or sell an option, and sometimes what strategy is most appropriate. So as I mentioned, it forecasts the expected move up or down of the underlying security with remarkable accuracy. It's not perfect, but it is remarkably accurate over the long run. And frankly, we don't need it to be perfect for our purposes. All right. So it's not going to tell us which direction the underlying stock will move. And that's okay. We're going to use other methods for determining direction or forecasting direction. All right. So let's get over to an options chain, and I want to visualize some of what we've just covered. Okay, this is not a current chain; it's a past chain, but it doesn't matter, right? This is still would be relevant if we looked at a current chain, and we will look at some. But this is one of the SPY, the S&P 500 ETF, which at this point in time was trading around 573 a share. And I will round up or down to the nearest whole number just to keep it simple. Okay, so SPY is trading around 573. And by the way, I'm demonstrating this out of the Thinkorswim platform. This information may be located in a different spot in your respective broker platform, but it should be in there. And I'll actually give you a way to figure it out if you can't find it. All right, so I'm going to go over to the right of the expiration cycle. We're just going to go one day out. okay, to a 1 DTE, October 7th. I'm going to go over to the right of that expiration cycle, and you'll notice there's a percentage and a number. We're not concerned with the percentage, it's an annualized vol percentile. We want that number, which says plus or minus 3.98, get all around there. So what is that telling us? Okay, plus or minus 4. It's telling us that the option market expects the SPY to move up or down by roughly 4 points over the next 24 hours. So some light bulbs should start going off now, right? Because we can use this critical information for all kinds of things. We could use it to set realistic stop loss levels or profit target levels, right? So if I were day trading the SPY on this particular day, okay, let's say I was bullish, I was going long the SPY. Okay, would I want to place a stop loss at 570 if I were to get in at 573? Absolutely not, right? I'd have a high probability of getting stopped out because it's inside the expected move. Would I want to place a profit target at 580 a share? Absolutely not, right? Very low probability of touch because it's outside the expected move. So there's all kinds of ways we're going to use this, and we'll look at some additional ones. As I mentioned, if you can't find this, a quick and dirty way to estimate it is add up the at-the-money straddle. That means you take the strike price closest to the underlying share price, so 573, and you just add up the premium on the call and the put side. And that's going to give you a pretty close estimate of the expected move. But that's what this number is. It's a critical number to use in virtually all of your trading decisions, even if you're not trading the option, right? Even if you're trading the underlying stock, ETF, or index. All right, so we're going to start to apply this. But first, I want to give you an expiration hack, because this is a big question mark in every trader's mind, right? Every option trader's mind. We have all these expiration cycles, right? And we didn't used to have this problem, right? We had one expiration cycle a month back when I started trading options. Now we've got 0 DTEs. Well, that creates some confusion, some uncertainty, right? Well, I'm going to show you how to reverse engineer the expiration cycle with the expected move. All right, so we're going to look at an example, and just bear with me. I'm going to get my options chain moved over to this screen here so you can see it. There we go. Okay, so let's say that we are bullish on Tesla. I just have a chain of Tesla pulled up. Okay, and let's say we expect Tesla to move up by 20 points, right, over our time horizon that we want to be in the trade. All right, so the first thing I want to do is pull up the options chain and then go over to the right and start referencing expected moves. So if I go out to March 23rd, what's the expected move out there? It's 1041. Okay, so the option market expecting Tesla to move up or down by just over 10 points by March 23rd. Okay, well, if I have a profit target goal of 20 points, I'm very unlikely to reach that by March 23rd. So let me go to March 25th. What's my expected move? Just under 17 points. Okay, we're getting closer, but again, if I have a profit target goal of 20 points, then I'm probably not going to hit it. It's possible I could, but the odds are not stacked in my favor. So let's go out to the next one, March 27th. What's our expected move? Just over 21 points. All right, now we're getting somewhere. Okay, now we have a realistic probability of reaching our profit target goal. So I'm simply using the expected move to reverse engineer the selection of my expiration cycle and making sure that I'm choosing the correct expiration cycle. Okay, so that's a little expiration cycle hack for you. All right, so let's get back to it. I want to dive a little bit deeper into volatility and talk about vol skew, because this is a big issue I see again on the retail side. It's either ignored, interpreted incorrectly, a number of things, but I want to make sure that you know exactly how to use this to select the right option strategy and making sure that you're not trading with the vol skew against you. So at the beginning of our session, I mentioned that most traders are entering trades with the odds stacked against them without even realizing it. Okay, and I see this happen all the time. So we're going to change that now. So first we have to understand vol skew. Okay, so it's essentially the difference in implied volatility across options with different strike prices or expiration dates for the same underlying asset. So a normal market will often show a higher IV for out of the money options than at the money options. And that forms a curve when you plot it on a graph. That curve will help us understand market sentiment and evaluate prices. So this is what it looks like, okay, on an options chain. So it doesn't matter what this stock is. I just want you to notice one thing. if we start at the money strike, at the 660 strike, okay, and we look at the implied volatility column, okay, those 660 strike puts have a vol of 16.19. What do we notice as we go lower in strike price or further out of the money? The implied volatility is increasing. So each strike price has its own volatility. All right, so this is what we call positive vertical skew. So it's increasing as we go further out. Now, obviously, the lower strike prices cost less on a notional basis, right? Like the 660s are offered at $4.14, the 650s are offered at $1.43. Clearly, those are less expensive. But here's the thing. The 650 strike puts are actually relatively more expensive. So in other words, you'd be overpaying for those relative. Think of it like getting a good deal on something, right? You'd be overpaying for those relative to the 660 strikes because they have a vol of 18.17, or sorry, 18.7. So they have a higher vol than the 660 strikes. This is going to become very important when we are trying to figure out which option strategy to use. All right, so there are two types of vol skew. There's vertical skew, like we just looked at, and then there's horizontal skew. So vertical skew is sometimes called price skew or strike skew. Okay, that just compares the IV of the options with the same expiration but different strikes. Okay, time skew, which is sometimes called term structure or horizontal skew, right, compares IV of options with same strike prices but different expirations. So you would be concerned with this more for like a calendar spread. Now, a normal implied volatility generally increases for options with longer expiration dates. You would expect that, right? Because the further you go out in time, the more can happen, the more uncertainty there is. So when you're in this type of term structure, we call it contango, right? Your shorter dated options are going to cost less than your longer dated options. When you're inverted time skew, we call this backwardation, right? Your near-term options will actually have higher IV than long-term options. And in fact, we're in backwardation right now in the vol futures. I'll just show you that here real quick. Let me drag this over. All right, so if we look at the CBOE VIX vol futures, okay, and we look at the April front month contracts, they're priced at 25.20. We look at the May contracts, okay, those expire 59 days from now versus 25 for the Aprils. They're priced at 24.35. Wait a second, what's going on here? Shouldn't it be the other way around? Well, no, it's telling us that something is going on right now that has the market spooked, okay? So this is really critical, and most of us know what that is, right? So it's critical information to have and know when we're in backwardation or contango. All right, so important to know, but what we're mainly concerned with is the vertical skew for selecting the right strategy. So I'm going to give you a trade evaluation blueprint, okay, using call and put skew pricing to determine, is this actually a viable trade? Am I using the right strategy? So we're going to look at some examples, okay? What I'm going to share now can be applied to and should be applied to any option strategy. So I'm just going to select a couple. We'll look at debit spreads, we'll look at credit spreads. Let's start with debit spreads, okay? Which is an option strategy involving buying and selling options on the same underlying asset, same expiration, but different strike prices. So it's a directional strategy. You can be bullish or bearish. So a bull call spread, right? You expect the stock to go up. You buy a call option at a lower strike, sell a call option at a higher strike. Bear put spread, right? You think the stock's going to go down. You buy a put option at a higher strike, sell a put option at a lower strike. All right, these are defined risk trades, and this is what they look like. But we'll look at some examples. But here's the important thing. We want to build a spread with favorable vertical skew. Again, one of the biggest mistakes I see option traders make without even realizing it, okay? We want the long strike in the spread to have lower IV or implied volatility than the short strike. So just think buy low, sell high, right? You want to do that with anything, right? You buy a house, right? You don't want to buy it high and then sell it lower later, other way around. Well, the same applies to options. So we're going to use the expected move to select strikes and then define our profit targets. All right, so let's go back over to this options chain. The key is to buy low implied volatility, sell high implied volatility. So this is what that looks like. The 660 strikes that we just looked at, right, have a vol of 16.19. The 655s have a vol of 17.1. So we could do a number of things here. We could do a vertical put debit spread, right? We think the stock's going to go up, or maybe we think the stock is going to go up, but it might stay flat, or maybe it'll go down a little bit. We could do a vertical put credit spread. Well, that would not be the right strategy here. The odds would be stacked against you because the vol skew wouldn't be in your favor. You'd have to sell the 660s at a lower vol and buy the 655s at a higher vol. Okay, so if you get any sort of adverse move in that position, you're going to have a more magnified loss in the trade. Okay, it's going to be harder to make money. And if any of you have ever just bought a call option when implied volatility is high, like maybe around a company's quarterly earnings, right? You thought they were going to beat on top and bottom line estimates and have positive forward guidance, and the stock was going to gap way up after the earnings announcement. So you went out and bought a call option. And the stock did in fact go up, but you may not have made money on that call option. You might be left scratching your head. Why did I lose money on a call option when the stock actually went up? Because very likely you traded that option, you paid too much for it, right? You traded it with high vol, okay? So this is the idea behind all this. So in this case, it's going to help us select the right strategy, which would be a vertical put debit spread. We want to buy the 660 strike, sell the 655. Now the vol skew's in our favor. All right, now we're going to incorporate expected move. So we'll stick with NVIDIA here. This is not a current chain, okay, obviously, but doesn't matter. All right, at this point in time, NVIDIA is trading at 177.75. All right, we want the strikes in the option spread to be inside the expected move. So if we're taking a directional trade, we just looked at this, right? You don't want to build a spread outside the expected move because you'd have a low probability of profit. So the first thing we want to do, first step is always know what your expected move is. In this case, that's 16, just over 16 points. So the option market's expecting NVIDIA to go up or down by roughly 16 points. So would we want to go out and buy a 150, 145, 5-point wide put vertical? Absolutely not. It's way outside the expected move. We'd have a very low probability of profit. But what about a 170, 165 put vertical? Well, if we subtract 16 from the underlying share price, right, we're well inside the expected move. And in fact, if you look at the probability of touch column just to the right of the volume column, we have almost a 70% chance of trading down to 170. So odds are in our favor right off the bat. Okay. Let's visualize this on a chart. So this is a past chart of NVIDIA. You'll notice a series of buy and sell signals, up green arrows, down red arrows. Okay, let's just pick one of these out. We'll focus on this sell signal from February, okay? So it's telling us that the algorithm forecasts NVIDIA to go down. Okay, well, as we can see in hindsight on the chart, it certainly did. So how would we build a trade around this expectation? We'll go back over to the chain. Okay, at this point in time, February 21st, NVIDIA is trading at 140.11. Okay, what's the first thing we want to do? We want to know what the expected move is. Okay, so out at the March 21st expiration cycle, it's just under 20 points. So this is going to help us determine or set realistic expectations for risk and profit target. All right, so since we got a sell signal, we're bearish on NVIDIA, we're going to go over to the put side of the options chain. Okay, and then we're going to use that expected move to make sure we're selecting high probability strike prices. So again, since we're bearish, we're going to subtract that roughly 20 points from the current underlying share price. That would bring us down to about 120. Okay, so we want to make sure we're selecting our strikes inside the 120 strike level. Okay, so we could do like a 5-point wide at, let's say, 135, 130. Now the next thing we want to do is reference the implied volatility column, to make sure we're not trading with the vertical skew against us. So if we look at the 135 strikes, those have a vol of 58.08. Okay, the 130s have a vol of 58.72. So there's a number of things we could do here. We could, even though we're essentially bearish on NVIDIA at this point in time, we could still do a put credit spread, right? We might think that NVIDIA could go down, but maybe it's not going to go down a whole lot, and we want to sell an out of the money credit spread. Well, that would not be the right strategy to select here because the vol skew would be against us. We'd have to sell the lower vol and buy the higher vol. So the correct strategy here for the vol skew to be in our favor is to buy the 135 strike and sell the 130. Now the vol skew is in our favor. So this is what building that trade would look like. Okay, going out to March 21st, going long the 135s, going short the 130s for a 5-point wide put vertical. This trade can be done for $1.85 debit. So that means if you're just trading one contract, you could put this trade on for 185 bucks. So this can absolutely be done inside a small account, and it's scalable, of course, based on your risk tolerance and account size. So if we did 10 contracts or a 10 lot, right, we would invest 1,850 bucks in this trade. Okay, that's one of the beauties of debit spreads, right? You can do these in relatively small accounts. Okay, so what's the profit potential with these? And I'm going to give you a little kind of framework hack for how I realistically set profit target or ROI goals on these types of trades. First of all, the maximum profit for this type of trade is simply the width of the spread minus the debit that you pay, and it is defined risk, right? So like if we did a 5-point wide spread, we paid a $2 debit, our max profit potential is $3. So that's good, right? We can make more on the trade than our potential loss. That's important. All right, so here's my little expiration framework for setting realistic ROI goals. So I'm going to take my time horizon. That's just simply how far on expiration I go. So like, let's say I build a trade 30 days out in time. Okay, 1/4 of the way there. So within the first week, I'm realistically looking for a 50% return on my trade. Okay, half DTE, that just means days to expiration. Okay, so if I'm building a trade 30 days out, sometime in the first 2 weeks, I'm looking for 100% return on my investment. Okay, if I'm going to hold all the way to expiration, that's where your max profit potential is on a vertical debit spread. I'm looking for that max profit. Okay, and remember, the max risk is always the debit that you pay for that trade. All right, so what were the results in this case? Well, we got a very nice, accurate sell signal back there, right, in February. So if we go out to 1 day prior to expiration, right, NVIDIA sold off. What happened to the 5-point wide put vertical? On March 20th, it picked up $3,150 in profit potential. Okay, pretty cool, right? So basically hit a max profit, 170% ROI. Alphabet, let's look at a buy signal. Okay, this is on Alphabet. At this point in time, Alphabet's in a strong uptrend. Okay, we have a series of buy signals along the way, a couple counter trend sell signals as well, but we want to trade with the trend, so we're focused on the buy signals. So let's look at the most recent one on the chart here. Okay, this buy signal came in August. All right, and it told us to initiate a bullish position if Alphabet trades up to 209.10. All right, so on August 26th, it triggered. Alphabet traded up to 209.16. So in this case, we'd want to go over to the call side of the chain because we're bullish and we got a buy signal. What's the first thing we want to do? We want to reference the expected move. It's about 13.5 points. So the option market is forecasting Alphabet to move up or down by roughly 13.5 points. We go over to the call side of the chain. Now remember, we want to build our position around or inside that expected move. Okay, so since we're in a strong uptrend at this point in time, I'll typically go right to the outer bound of that expected move, okay, because we have a lot of positive momentum in place already. All right, so we're going to go out to the 220, 225s for a 5-point wide call vertical. What's the next step? We want to reference the implied vol. Make sure that we're not trading with the vol skew against us. Well, the 220 strikes have a vol of 34.17. 225s a vol of 34.48. Okay, so again, we could do a call credit spread, which is more of a bearish to neutral strategy, but Alphabet could go up and we could still make money as long as it doesn't go up too much. But that would be the inappropriate strategy because the vol skew would be working against us. So the appropriate strategy to use here would be a vertical call debit spread. Okay, we're buying the lower vol, selling the higher vol. And as you start to implement this in your own trading, you'll immediately notice a difference in how the trade behaves, even when you get an adverse move. Now, this isn't real heavy vol skew, right? It's fairly even, right? But there will be scenarios where you can get really, really heavy vol skew working in your favor. And what's really exciting and powerful is that when you get into a trade with heavy vol skew in your favor, even when you get an adverse move in that trade, so in other words, the trade moves against you, you may not even notice much of a loss in the trade. I've had scenarios where the trade moved against me and I actually had a profit in the trade because the vol skew was working so heavily in my favor. Okay, so how do we build this, right? We go over to the order dialog box. We type in a long 220 call, a short 225 call for a 5-point wide put vertical. This particular trade could be done for a 92.5 cent debit. So if you're just doing one contract, you could put this trade on for literally 92 bucks. Okay, you could scale it up to 10 contracts and invest $925 in this. Okay, totally scalable based on your risk tolerance and account size. How did this one work out? Well, as we see after that buy signal in August, NVIDIA continued to move up. We go out to September 12th, which is our expiration day. And this particular trade had a profit potential of $3,900 on 10 contracts. Okay, just using exactly what I've demonstrated to you so far, using the expected move and selecting the appropriate expiration cycle and strategy based on the volatility and that expected move. All right, let's shift gears a little bit to another strategy, credit spreads. So I also trade credit spreads. Back when I started trading these in like the early 2000s, I was selling very low delta out of the money credit spreads because they had a high probability of success, right? So I was, winning 10, 12, sometimes 15 trades in a row. But the problem is when I would lose a trade, it would wipe out a lot of my winners because they have an unfavorable risk reward skew. So I've transitioned into trading more at the money and in the money credit spreads, right? That might sound crazy to some people, but here's a real world example of where I did that on the VIX in my hedge fund. So this is out of my hedge fund, Altos Capital. Okay, the VIX had spiked. All I did was use the expected move in the heavy vol skew. This one had very heavy vol skew on the call side. And I sold an in the money call credit spread on the VIX because I know volatility is ultimately going to contract. It's just a matter of time. Okay, so I went out, I think a couple weeks in expiration, and I sold an in the money 1722 5-point wide call vertical credit spread. Okay, I collected almost $7,200 for putting that trade on. But here's the cool thing. I only risked $1.39 to make 361. So instead of like what I used to do more frequently back in the early 2000s, where I was risking, right, 361 to make $1.39, I flipped this all around, just using heavy vol skew and expected move in my favor. So very favorable risk reward skew. And this one, advanced too quickly there. This one I closed out, not for a full profit. So I ended up booking profits a little early on this one, but captured about almost $6,000 of that $7,200 profit potential. Okay, and that was on 20 contracts. Okay, defined risk reward in my favor, vol skew in my favor. I used the expected move and selected the appropriate strategy. Simple as that. All right, now I'm going to transition again here to something really exciting. AI, of course, has become all the rage these days. And I'll be perfectly honest, I resisted it at first. I was skeptical, I doubted it, but it became so widespread, I thought, I got to give it a chance. I've got to see if this actually is relevant to my trading decisions. And I quickly realized it is. And I'm going to walk through some of the reasons for that, but this is really changing how retail traders compete, right? It's a real game changer. So before we go any further, okay, I want to show you something that's changing the game for traders right now. Because remember, I talked about my goal of leveling the playing field, narrowing the gap between the retail and institutional side. So this isn't hype. It's not some black box system, but it's about how traders are starting to use AI as a tool to get an edge. Because whether people realize it or not, this is already happening, okay? So the reality is the game has always been a little uneven, and I have the inside look to that since I trade on both the retail and institutional side. Institutions have always had better tools, better data, faster access. Retail traders have typically been a step behind, but right now, for the first time, the gap's starting to close because AI is giving everyday traders access to tools that used to only exist at the professional level. All right. So again, we need to narrow that gap. And I think AI is a tool that can level that playing field. for the retail side. So the edge is happening right now with speed, information, and clarity. So I want to be really clear about something. AI is not here to magically predict the market. If it were that easy, we'd all be very wealthy and retired, right? But what it does do is it processes information faster than any human can. So it takes massive amounts of data and it turns it into something that you can actually use. And that's where the edge comes from. So we can use it to identify unusual volume or momentum, right? We can scan hundreds of charts instantly, spot trending sectors quickly, and surface what's moving right now. And I'll be the first to raise my hand, right? I've identified some really incredible trade opportunities over the years that I never acted on because the market moved too fast, because I was stuck, right? I got paralysis by analysis. I was trying to analyze all these things. And although I was ultimately correct on my outlook, I couldn't do it quick enough, right? And that's a real problem. So think about how most traders operate. You're flipping through charts, watching a handful of stocks, trying to catch something moving. AI can scan hundreds, even thousands in seconds. It can surface unusual volume, momentum, things that are starting to wake up. So instead of guessing where to look, you're starting with where the opportunity already is. And that's critical, right? Because for those of you who know me, you know that I'm a huge advocate of forward-looking information, and I'm heavily against lagging indicators, right? I've tried them all, and I've thrown them out the window. All right, so now once you have an idea, this is where most traders fall apart, okay? So you get the idea, you have a trade thesis, you're ready to act on it, but there might not be a plan or a structure in place, or you're just reacting to the market. That's difficult not to do. Most of us are reacting to the market, okay? But AI can help slow that down. It helps you think through entries, exits, risk, reward. So you're not just taking trades, you're building trades with intention. Okay, so the power here is that it can help us do so many things: define entries and exit rules, build clear trade plans, map risk versus reward before entering, create repeatable setups, which is a big thing. Once we've identified an edge, we want to repeat that as much as possible, right? So here's another big one: information overload. So you've got news, earnings, reports, there's too much to keep up with. So AI can break that down really fast. It can summarize what actually matters. It can highlight risks, and it can point out what could move a stock. So instead of reacting late, you're actually understanding what's going on now, right? Critical, especially in a fast moving market environment, right? Things used to move a lot slower when we had to read the newspaper, right, to get our financial news. Now everything happens in milliseconds. So we need to cut through that information overload. So AI will show you what most traders miss. Okay, charts are another area where this helps a lot. So let's just be honest, right? Most traders either overcomplicate charts or they miss what's right in front of them. So AI can help highlight trends, key levels, potential setups. It doesn't replace your judgment, but it gives you a second set of eyes that doesn't get tired or emotional. So it can help us identify trends faster, highlight key levels in terms of like support and resistance, recognize breakout setups, confirm trade ideas with data, all kinds of really cool stuff. Now, this might be the most powerful part. So that's actually improving as a trader, right? That's what we all strive to do. So most people take trades and then they just move on. There's no review, no real learning. I encourage all of our members at Altos to learn from the trade, whether it was a winner or a loser. Okay, AI can help you look back and see patterns. So this is where it gets really exciting because we can optimize our results. What's working, what's not working, where are you making mistakes? That's how you start getting consistent. So we can analyze past trades, identify mistakes and patterns, find your most profitable setups, improve consistency over time, and really optimize it. So I want to say this clearly. This isn't about letting AI trade for you. That's not the game here. This is about making you a better trader. All right, so better decisions, less guesswork, more structure. It's a tool, and like any tool, it's only as good as how you use it. Now here's where this gets really interesting, okay? Because everything we just talked about, finding opportunities, building trades, managing risk, that becomes even more powerful when you combine it with a clear, repeatable strategy. And that's exactly what we're gonna walk into next. So this is exactly where what we're about to show you becomes even more powerful. So we've dipped our toes in the water. Now it's time to jump in and swim, take it up to the next level. So we are hosting a spring 2026 trade tactics bootcamp. Okay, this is part of our trade tactics bootcamp series at Altos, from chart to cash flow, utilizing the AI trading edge. So we're going to be building all kinds of really powerful AI tools and methods into our trading decisions in the spring 2026 trade tactics bootcamp. So I'm going to walk through the details of the bootcamp and then let you know how you can be a part of it. So this includes a proven system for spotting market moves days before they happen, high probability setups and strategy tweaks that boost win rates fast, using a repeatable process for income trades that pay, using pro level tactics. So pro level, what does that mean? I mentioned I'm a hedge fund manager, right? So I trade on the institutional side, but I also trade on the retail side. I trade my own account, okay? I'm going to be sharing with you a lot of really powerful institutional level tactics to help cushion trades, manage trades into profitability, build hedge fund style positions. We record the bootcamp sessions and post them in your members area. So you can access all the replays and recorded training sessions. I'm hosting these personally, so I'm there to give you full support and coaching. We're going to also spend a considerable amount of time on trade management. So of course, we'll talk about trade entry, trade exit, but what about everything in between? How do I manage the position when the market throws me a curveball, right? We're going to go into different tactics for adjusting and managing trades. And this is the really new and exciting part. We're going to incorporate AI-powered tools to help you trade smarter and faster. I'm very, very, very excited about this because we're also going to be introducing our own proprietary AI trading tool. This is a first-time release. We've never released this before to the public. We're going to look at how to use AI to scan, analyze, and validate trades in seconds. So even if you build a trade on your own and you're wondering, should I get in it? Actually click my mouse button and route this to my broker, right? We're going to look at how to validate that, eliminate emotional decisions and second guessing, turn overwhelming market data into clear trade setups. Okay, a lot of really, really powerful stuff, but there's even more. So I'm going to walk through in detail everything that's included in this 3-day bootcamp, and then I'm going to open it up to questions. Okay, so it includes full access to the private 3-day bootcamp. We initially planned on doing this as a 2-day bootcamp, but decided to throw in day 3. You're also going to get our 5-step profit protocol for any account size, how to use trends to master market moves before they happen, exact rules, filter setups, and selection process. So we're going to be giving you powerful cheat sheets and strategy guides throughout the bootcamp that you can reference, and we're going to go through all the details, so there are no question marks. Okay, as I mentioned, we're going to go through managing positions, adjusting positions, and incorporating AI into our trading decisions so we can make faster, more confident trade decisions. And then we're throwing in a third bootcamp day as a bonus. So the total retail value on this is over $6,800. Okay, we are knocking 95% off this 3-day bootcamp. You can literally get all this for just pennies on the day, right? $297 locks you in. We are limiting this to 25 seats because we want to keep the group small. So it's fair to you. You get all of your questions answered, and we're not trying to juggle hundreds and hundreds of bootcamp members. Even though I know hundreds and hundreds of people want to get into this, we do have to keep it limited, and I apologize for that, but that's just the reality. So it's fair to all of our bootcamp members. So if you want to be one of those bootcamp members, altostradinglive.com/go is the link. And I believe the Trade Thirsty team will put that link in the chat for you, so you can just click right out of there if you want to scoop up one of those 25 seats. All right, the bootcamp dates, okay? Day 1 is scheduled for April 1st at 6 p.m. Eastern time. We don't have a hard stop on these. We don't have a predetermined time allotment because I don't want to limit us. We'll go as long as we need to go till all questions are answered, everyone's comfortable. Because the reality is we're going to have bootcamp members of all experience levels, right? Everyone has a different background, a different level of experience, and I'm not going to assume you know anything. So I just want to make sure there's time for everybody, right, to feel comfortable and to feel confident. So probably we'll run, a couple hours. I would just estimate based on past boot camps that we've done, but it's open, right? So day 2 will take place on April 8th, same time. And then we're going to throw in the bonus day 3 on April 10th. that time is to be determined. We'll let you know on that one, okay? Those are your sessions. Mark your calendars. Again, everything's recorded, so even if you are not able to attend, that's perfectly okay. It's still going to be interactive for you. So we are going to hold these over Zoom. You're going to get all the Zoom recordings and access to the members area, all the cheat sheets, strategy guides, and you can still ask me questions. Okay, so any bootcamp member question will get routed directly to me, and I'll be directly answering those. All right. In the interest of time, I'm not going to go through all the testimonials that we receive on a regular basis, but just know that we do receive a lot of testimonials, and this is frankly why I do this. I want you to be my next testimonial. That's where I get the enjoyment out of this, is watching traders increase their confidence and consistency. That's why I love it. All right, so again, that link is altostradinglive.com/go. I'm going to go ahead and open it up to questions. Let me just look at the time. Okay, looks like I have a couple minutes maybe. So if you have any questions, please put those in the Q&A box. I'd be happy to answer those. And I'll throw up the package again here for you as well. All right, so I'll just start answering questions here and quickly. So again, bootcamp is over the course of 3 days. They are all recorded, yes. Are there any additional charges during the bootcamp? No, everything that you see here on your screen is included in that 95% discount. Okay, so you get everything that you see there on the screen. Okay, let me just make sure I'm looking at the right ones here. Okay. All right. Yeah, so got a question on trade alerts. So over the course of the bootcamp, we are going to be building some trades together. Okay. We do also issue trade alerts. We offer trade alerts outside of the boot camps. And if you're interested in those, yes, we can hook you up with those during the boot camp. Let's see, got a question. Do Altos Platinum members have access to this? Oh, might be one of our VIPs. Yes. Yeah, so this is available to anyone who is serious and wants to be a part of it, including our VIP members. It just is limited at those 25 seats. Jay asked, is there a simple call and put option? Yeah, so we're going to be covering a lot of different option strategies, all the way from just simple calls and puts to vertical spreads, right? So we'll cover different strategies, but it's not going to be complex. So we're not going to be doing any crazy, like, I don't know, Christmas tree trades where you've got like 5 different strike prices. It'll be pretty simple, okay? That's my teaching style. I break everything down and keep it simple. But remember, it's interactive, so you can ask questions along the way. Let's see, another question, AI Trading Edge System scanning software. Do we have access to that? Good question. Yeah, so you're gonna get access to our proprietary AI tool, okay, during the bootcamp. So you will get access to that during the bootcamp, and any other AI tools that we use. So for instance, we're gonna be looking at different methodologies for utilizing AI in terms of, for instance, prompts, analyzing trades, helping us select trades. So we'll be using it in lots of different ways, but anything that we do use, you will have access to, absolutely. All right. It looks like I answered all the questions. I want to thank all of you for being here. I hope you learned a lot today. I hope you found this information a valuable addition to your trading arsenal and your trading strategy. I hope it helps you make more informed trading decisions, trade with more confidence. And I'm really, really excited and looking forward to kicking off the Trade Tactics Bootcamp here in just a couple short weeks. Looking forward to seeing all of you who are locking in that 95% discount today on April 1st. With that, Jeanette, I'll pass it back to you. Thanks for having me.